Okay, so welcoming everyone to the first live webinar session of the Investing in Equity course by BIC, Bangalore Investors Club. This is Dr. Musa on the session, and we have Vetri in Bangalore and Talib in Tanzania with us. So welcome to you both. It's really, for me, definitely a pleasure to have you and to be, in a sense, one small landmark that we have achieved in BIC, and thank you for being part of that experience and that memory, right? So what we want to do is just jump into the course and start with the first session. So you should be able to see the slide now at your end. In case it's something else, please let me know. And what you actually see and is a maze, right? And just to point out, essentially where we are on this whole on this whole journey is, or even before I get there, what is your goal in this maze? If I asked you, what is it that you want to reach? Have a look, and where do you want to reach in that maze? Anything?
IPO millionaires.
Come again?
IPO millionaires.
IPO millionaires. Okay. Anything else?
To the dollar bag.
To the dollar bag, right? You want to reach this. This is what you want, right? That's the goal of this. You want the dollar bag. You want this bag of fortune, and you want to be able to do stuff with that, right? Now, how many routes are there, and where are we at this point? We are at this point entering here, right? And where you want to go is there. And my question next is, how many ways are there from this to that? How many ways are there?
Multiple ways.
Right? So there are multiple ways. And are there any terms that you see there? I'm not expecting you to understand any of what is there, but just just for fun. Are there any terms on that screen that you are familiar with, or you have read, or are aware of? Anything?
Yeah, multiple of them.
All right. So any one or two, Talib?
OPEC, trade deficit.
Okay. Vetri, anything you have ever read, might have seen on a billboard, on a newspaper, doesn't matter. Anything familiar? Which one? Okay. Okay. Right. So this brings me to one question for all of us. If you are on a journey, you want to go from point A to point B, right? What is the route that you're likely to take for going from point A to point B? Now, there are many answers to that question, right? Are you going to take the fastest route? Are you going to take the most convenient route? Are you going to take it slow and easy, etc.? But think about what I'm going to say next. And what I'm saying is that most times in life, it's not about the fastest route or the most convenient route. It is usually about which is the most familiar route. When you're going from some place to another place, whether it is even, you're going from your house to your office or to a club or to a friend's house or wherever, we tend to take what is familiar. And I don't know how it is in Tanzania, but if you're here in India, Bangalore, almost all the cities, horrible traffic. And if one day, instead of you taking your car, you went in a taxi, then the taxi guy is probably going to go in the same direction you're going, but take a different road and maybe go inside a side road here, there. And that's suddenly going to open up a different world for you, and you say, how come I didn't know this road? It saved me 15 minutes. I'm always going only on the main roads. I don't go through the gullies, and I'm losing 15-20 minutes every day. And suddenly you're wondering why you did not go there, because for years you've just been going down the familiar road. Okay. Now, why I say these things and why I think these things are important is because in any journey
Uh,
that, yeah,
Sorry,
yes,
I think battery signal is very weak. So
okay,
he said he's going to try and correct through the LAN.
okay, so let him join, right? Okay, thanks for that.
Problem.
All right, so uh, the journey we usually take will be the one which we are familiar with. And why I'm saying this is when we are beginners in any new thing, and especially definitely in the markets, one of the things I would definitely encourage all of us to do is look at things around you or about your work that you're already familiar with. Instead of trying to learn something completely new and new jargon, new meanings and all. There could be a road here which, like for example, Talib talked about OPEC and all of that. So he knows about something about oil, something about the crude oil price, and something about maybe refineries. You never know. But what I'm basically saying is start with what you are comfortable with, what you know, and build on that, right? And then once you've gotten comfortable with getting to this bag of gold using what you already know and then adding what you're going to learn in this course to that, then your confidence will grow faster, your results will happen faster, and then that in turn will give you a lot of healthy feedback to try and do something different and maybe take a different road next time on and something unfamiliar, because now that you're familiar with a certain route, you'll have that confidence to go a different way, right? So I highly encourage you to look at things that you're already aware of and build that. So if you're an engineer, then I don't know, maybe you're a software person, you know about telecom, or you are a doctor and you know about biotechnology or something, then use that knowledge to your advantage, right? Okay, so this is just to break the ice. We are in the beginning of this maze, obviously, and what we want to do is find practical ways of getting to this bag of a small fortune that we are looking forward to, right? Just to quickly talk about the sessions that we're going to have. Basically, the course is into day one, day two. Of course, this is the classroom format, but there are 8 sessions basically we want to cover. And what we want to cover in this first session right now is what is equity, types of equity, and what are corporate actions. So we want to start right from the basics, right from scratch. So if you know something, then great. I'm sure some of it will be repetition, but some of it will also be clarification. Very often I have seen that sometimes, a lot of times rather, including myself, when I look back maybe 10, 15 years back, there are things that I just assume I know. You take a word, there's an English word, you say, okay, fine, that's what it means. But when you get into the details, it's not exactly that, it could be something else. So we are going to clarify all that and set up the basic concepts right in this session. We'll look at, in the next session, factors impacting the stock markets and stock prices. And these are like broad macro factors, and today in a very interconnected world, this has become even more important to understand. Right before the session, when we were just doing introductions, Talib was talking about companies he's familiar with in Africa, or I might be familiar with stuff in India, etc., and you might be in US or UK or whatever, but you cannot ignore anymore, for example, crude oil prices. You cannot ignore what's happening in China. You cannot ignore what's happening in the Middle East, in Syria, and maybe the Israeli-Arab conflict, or you can't ignore what's happening in Brazil with Dilma Rousseff getting impeached and the Brazilian economy going for a toss, and how that could then impact the entire BRIC countries, and who knows, right? So you've got to get aware of these things. So in the second session, we're going to discuss just some of the broad factors, and then you're going to have to sort of connect the dots, right? So one of the key skills of successful investing is being able to connect these dots. Those dots are just floating around there. It's there in the news, it's there around you, it's there in the shopping list that you have, it's there in the conversations, it's there in your workplace. But being able to connect all that and create an investment story, if I can put it that way, right? That's the biggest skill that we want to be focusing on. Then we will then look at fundamental analysis, and just to very quickly introduce the concept of fundamental analysis. Fundamental analysis is all about analyzing a company from the perspective of its financial performance. Is it making money? Is it likely to grow? Is it going to, business is going to expand? All those things. So we're going to have 2 sessions on that, and we're going to look at different types of fundamental investing, and we're going to focus on value and growth investing, and then most of the other stuff is a spin-off of this type of investing. So very interestingly, Talib already mentioned before the session started in the introductions that about how dividend yields in the Tanzanian exchange were in the region of 10-15%, but now they're in the region of 2 to 5%. So essentially what he was referring to was value, right? And then saying it was cheap before and it is expensive now, right? But then there is growth, and that's a completely sort of diametrically opposite way of investing into FA. And what are the things you need to look into that? So we'll take live examples from the Indian markets, look at the data in FA, and take a call on where is the market right now. So what I would encourage all of us to do during these sessions also is, especially if you're watching this later, is to look and identify current data, right? You want to see live data current to your market of interest, and then ask the same question about where is this market now in the scheme of things, right? Okay. Okay. So that was the sessions on FA, and once we've done that, then we look at technical analysis. And technical analysis, just to keep it simple for now, is the analysis of charts. It's how and what chart are we talking about? The price chart of a stock, and how is that chart to be interpreted, and what can that chart pattern tell us about whether the stock is likely to go up or it's likely to go down, and then how do you use that in turn for technical analysis based investing and trading. One thing to add as far as technical analysis goes is that there are many different approaches to technical analysis, and what we are going to be focusing on in this course is what is called DOE theory. And the reason I'm focusing on DOE theory is probably that's not only the easiest to learn, but it's also the most widely practiced globally. And these are terms that you would have already heard of. Perhaps you've already heard of terms like support, resistance, etc. These are terms that come from DOE theory. So these FA and the TA part are your analytical part, and that's what gives you the map of the market, right? So that's a nice concept to remember, the map of the market, because you need to know where the market is going. Is it going up or is it going down? You don't want to be buying something where the price is going down. You don't want to be out of something where the price is going up. And basically FA and TA together, and each of them have their advantages and disadvantages, will give you the picture that you need to make a decent decision. Once we finished all this, then we'll have a session on investor psychology. Psychology is not really something, in my opinion, that can be taught. It's something more that you need to experience. And we're going to look at certain biases, thinking, what should I say, habits that we have which come in the way of successful investing. One of the things that you will realize much later at a sort of very deep level is that you can have fantastic knowledge. You could be a PhD. I could be a PhD. But then does one have the emotional ability to take risk, right? And how good are you at being comfortable with not knowing the outcome? Human beings have this deep need to know. Tell me what is going to happen. Yeah, if I tell you I don't know what is going to happen, and by the way, that's the honest answer. Nobody really knows the future, right? But we don't take that aspect seriously. But in the markets, you're going to have to take this market seriously. Let me put it as a very blunt thing right now. If you want guarantees in terms of profit, then the only thing you should do is put your money in a fixed deposit, right? The bank will tell you we're going to give you 6% or 8% or 9%, and it will give you a certificate. It will give you a date. It will tell you when the maturity will be. That's it, right? Or anything like a fixed deposit. Anything more than that, if you're truly interested in making meaningful wealth, then you will have to take risk. This word risk, right, is perhaps, and I'm not saying this lightly or jokingly, is the most important 4-letter word in your life. you have to understand risk. Intellectually we know it, but we don't really, how would I put this, appropriately apply this in our lives, and we will definitely have to step up to the plate as far as applying it to the markets is concerned. So more on that and the investor psychology session. And lastly, and perhaps most importantly, is the last session, creating an investment and trading plan that is suitable for you. One of the things that I'm going to promise you right now is that once you've done your FA and TA, you're going to have a pretty decent idea of at least half a dozen, if not more, distinctly different approaches to investing and trading, right? Now the question is, which approach should you use, what is relevant to you, and what suits your circumstances, your personality, etc. And according to me, that's a question that is best answered by you, not so much by me, right? So in the last session, what we're going to do is have a discussion about pulling all the knowledge plus circumstances in your life and your plans ahead, and then say this is perhaps the best way of going about it. Now, who is going to say this is the best way? Not me, it's going to be you, right? So that's where we would like everything to come together, not in just in terms of the market knowledge, but how does this knowledge fit into the rest of your life? I generally don't like to look at things separately and say, oh, this is not connected to the rest of it. One of the things that you will see once you get into the markets is, once you get a sense of the opportunity in terms of how much money can be made, your life will probably not be the same again. Whether you make that money or not, that's a different point altogether. But once you get a sense of what's possible, that's really going to take you somewhere else. So those are the 8 sessions that we have. Hopefully we should be done in 8 sessions, but like I said, we're doing this for the first time, and if we definitely need more, then we will definitely slot that. I have no intentions of cutting corners or shortcutting anything, right? All right, so we'll figure that out as we go on. So you're seeing a cartoon, and I should probably have found a better one, but I've been using it for a long time, so just sort of got comfortable with it. And the question that is asked is, how wealthy do you want to be? Correct? That's what's there. There's a man looking out into the horizon, into the future, and is asking this question. Well, 4%, 7%, 8% for somebody who is in India or in Africa or in East Asia, I would say, is like, what's the big deal? I get this in a bank, I get this in my savings account, I get this in a post office deposit. Why should I be bothering? What I want you to do is think about, what do you want to put before the digit, before the 4 or after the 4, before the 8 or after the 8. And I'm not asking this as a casual question. It's something I really want you to think about. Maybe after class, maybe you want to switch your phone off and take some time to get a sense of what the market can do for you. Or actually, let me put it another way. I think a better way is to ask the question, what you could get by taking active part in the market. What if you could get 40% returns? What if you could get 10% or 20% returns consistently? What if you could get 70% returns, right? Taleb already mentioned that he put an X amount and that became 5X. Even if 1X became 5X over 5 years, that is a brilliant opportunity. That's a brilliant return, right? And tax-free, usually, globally. Think about it another way. If you put in money in your bank in India at say 8% over 5 years, 8 into 5, you'll get 40% on your investment. But if you did a 5X return, you're getting 500%. What impact does that have on your life? So this question, how wealthy do you want to be, is a very serious and a very specific question. Put a 0 before or after. And what I'm saying is, it is possible, right? By the way, there's something I want to say at this point. Please do not believe anything I'm going to say. Okay, now that might be a very stupid thing to say, a very startling thing to say, but here's my point. If I cannot back up what I'm saying with data, with publicly available data that you can independently verify, then don't believe what I'm saying, and I will say don't believe what anybody says, right? This world is already full of people who are making all sorts of tall claims. I have no intention of being one of those people. If I cannot back up with data, and I think as a practice, anything that you do in your life, whether it is, I think everybody knows my background is now in finance and in medicine, and especially in those two areas. And the third thing I usually add is law. Legal matters, financial matters, and health matters. Don't believe anybody, don't believe the media, don't believe ads, don't believe a quack. And the problem is there are too many quacks and too few serious people around. And you want to be in a position to be able to ask the right questions, because this is directly going to affect you, right? So coming back to the slide, I said 40%, 70%, 80%. Is it possible? Yes, it is possible, and I'm going to demonstrate that through the course, right? But to look at some of the simplest data that there is out there is this table, okay? So what is this table? This is a table of a list of stocks, some of the blue chip stocks in India from 2003 to 2009. Right? I know we are in 2016 right now, so there's 7 years of data which is not there on the screen, and it's not there for a particular reason, and I'll come to that in a little while. There are two sets of numbers. So let me start with ACC, right? By the way, this is not some list which was selected to demonstrate anything. At the end of this discussion, I would encourage you to have your own independent, analysis and see what we are going to discuss here is true or not. So let's take ACC for example. The black numbers that you see on the table, all the black numbers are what the price of that stock was on the first trading day of that year, right? So if it was not 1st Jan, it will be on 2nd or 3rd Jan or whatever it is of that year. So ACC on 1st January 2003 was 164 rupees. This is public information. You can find this out anywhere you want, right? On 1st Jan 2004, the stock price was 259 rupees. Okay, that means it went up by 58% in 1 year. ACC went up by 58% in 1 year. Bharti went up from 22 rupees to 111 rupees. It went up 400% in 1 year, 4x in 1 year. Okay, so the blue numbers are the year-to-year return from 1st Jan of the previous year to the 1st Jan of this year. Okay, the black numbers are the actual stock price. Are we clear about this? Right? Okay, great. My question, very quick, we're going to have a series of questions on this. What is the, I just want you to do quick mental math. Don't use a calculator, don't use a mobile phone, nothing. And in 2009, you've got a lot of negative numbers too, right? So you've got minus 50, minus 60, etc. My question to you is, what is the average of the blue numbers? What do you think is the average of all the blue numbers on the slide that you see? Just quick math. A guess is fine. You don't have to be accurate. Put that in the chat box or unmute your mic, whatever.
About 30%?
About 30%?
I would say 80.
You'd say
80%.
80? All right, fine. Doesn't matter. So Vetri is saying around 30%, Talib is saying about 80%, and in case you're watching this recording later, just have your own guess. And this is what the Indian market has done from 2003 to 2009. Now, especially if you are new to the market and your first time, one thing I want to point out, nowhere have I mentioned, and it is not implied, that, for example, when Bharti went from 22 to 111, it was every day kept going up one step at a time, and there was no down days or down weeks or down months, right? Bharti could have gone from 22, it might have gone to 10, then gone back to 22, and then gone 50, came back to 30, then went to 100, came to 60, and then all that. So up and down, up and down. So I do not want you to think that this was one straight line with no falls at all. But if you held, then these are the results that you would get, right? Now it's not important whether it is 30% or 80%. The point is it well above what you would have gotten in a bank? Right? Not just few percentage points, but 20, 30, 40% more than what you would have gotten in a bank, right? Okay. Now, like I said, these stocks I've selected here, or rather not selected. So I'll tell you what the process was for saying ACC, Reliance, Infosys, Bharti, etc. It was very simple. I said, let's just take some different industries in India, and which is the top company that comes to your mind from that group. So if it is cement, at that time it was ACC. If you feel Grasim is what you should have, then check out Grasim. Petrochemicals, Reliance. If you feel ONGC or BPCL or HPCL, then take that. When I thought about IT space, I thought about Infosys. When I thought about telecom, I thought about Bharti. Instead of that, you can put Arcom or you can put Idea, anything, right? So essentially just look, and the other thing is that even if you've never been in the stock market at all, these are names that you are familiar with. These are products that you have used in your house, or you're driving a Maruti car, or maybe using an ITC product or whatever. And if you may never have used anything to do with L&T, but you've seen this big company's name in thousands of places when you're traveling on the roads or at the airport, on construction machinery, on billboards, on wherever else. So one reason to select these companies is just simple familiarity with the public. Even if you have zero knowledge about the market, you at least know that these companies exist, right? So make your own list and see what the results are. Make your own list from the region that is of your interest, of Africa, Europe, Japan, America, really doesn't matter. All right. Now here's the real important set of questions that I would like us to answer. So I'm going to change the slide and I'm going to skip back to the slide, right? What are the stock prices today? Doesn't have to be accurate. I have all the data with me right now, but that's not important. Even a guess is fine of the stocks that we had listed. And then I want us to go through these scenarios, which are, what would your returns be if you had bought the stock and then sold the stock under different scenarios, right? And what are the different scenarios? You bought and you continue to hold them through the 2008 crash. So I'm not going to get into the crash, but we all know in 2008 the world economy collapsed, right? Stock prices fell, real estate prices fell, commodity prices fell, people lost their jobs, some companies got closed, especially in the US, several hundred banks collapsed, people lost money left, right, and center. None of that happened so much in the rest of the world, but what happened in US did affect us here. And if you were an IT guy in India in 2008, 2009, you know that your job was at risk. You know people who might have lost their jobs. You know people who did not get a job simply because they were at the wrong time at the wrong place. As simple as that. They might have been first in class, but they didn't, get through. Now, if you had bought the stock and held through even today, so in 2016 you were holding it, what would have happened? Another scenario is you had bought the stock in 2008 and sold in 2009, like a lot of retail people did across the world. Then what would have happened financially? If you had bought in 2003, 4, 5, sold in 2008, and then bought again in 2009, and then you were holding today, what would have happened? Or if you had just bought in 2009, 10, and maybe you're new to the market, and if you're holding today, what would have happened, right? So one of the most important things is, when do you buy and when do you sell? So let's go back to this table and look at these 3 or 4 different scenarios that we have put up. Now, let's study this a little more in detail, okay? Let me come to 2008 first, right? Let's just focus on this 2008 column. So the black prices, the black numbers, like I said, are what the stock price was on the 1st of January 2008, correct? 1 year later, this was the price. Now, what is the difference? What's the average difference between the 2008 and 2009 prices? What do you think is the average difference between 2008 and 2009 prices?
Between 30 and 50% down.
Between 30 and 50%, at least 30% down. There's 26, there's also 60% down, right? In 1 year, had you invested in 2008, 1 year later you would have lost half your money. You would have lost half your money, and that's no joke. And it doesn't really hit you. It's very nice to say. See, if you invested, I don't know what, 10,000 rupees and you lost 5,000 rupees, you probably not feel too bad. You'll feel bad, but you'll say, okay, why? Because the absolute amount is not much. 5,000 rupees is not a lot of money today. A lot of us have lost much more than that doing stupid things, or have gone to a restaurant and spent much more than that. So you say, okay, 5,000. But what if you had invested ₹1,000,000, 10 lakhs, and you lost half of that? You lost 5 lakhs, or you'd invested a crore, or $1 million, and you lost $500,000. Then how would you feel? It's the same 50%, right? So it's not like you're talking about small losses here. You're talking about massive hits that you would have gotten on these investments had you done them in 2008, right? I'm not even coming to 2016. Now let's look at another scenario. Suppose you had bought these stocks in 2003, 4, 5, all right, and you were still holding them after the crash of 2008-9. Would you be making money? If you bought them in 2003, 4, 5, and you were holding them in 2009, would you be making money?
Yes.
Maybe break even.
Maybe a bit.
Maybe a bit.
Yes.
Okay, maybe a little bit, maybe not. But okay, you're not really losing money, right? Okay. Let's look at a different scenario. If you had bought the stocks in 2003, 4, and 5, okay, and then you had sold them in 2008 at approximately these prices, 10% up or down from these prices doesn't really matter. So I'm repeating this: 2003, 4, 5, you bought it at these prices, you sold it at 2008 prices, you sat on cash for 1 year, and then you bought them again, the same stock you bought 1 year later at these prices, and you're holding today. Then how much money would you be making? Okay, so which brings us to a different question. What are the prices today? How much is ACC today? All right, so ACC, Reliance, Infi, Bharti, SBI, Maruti, ITC, L&T, so, and Cipla, right? All right, so just let me just quickly get up the chart. Don't get overwhelmed with all the numbers and all of that. So ACC, right? Do you see ACC on your side?
Yes. Yes.
Right?
Yes.
It is 1,400 rupees. It's been around 1,400 for the last 2-3 years. I've put this as a yearly chart just to have clarity. Just don't worry about all the colors and this, that. We are going to deal with that in subsequent sessions. There's a blue border here, sorry, a yellow triangle. That's the price that will tell you. So ACC is 1,400. Reliance is 1,040, right? Just to quickly let you know where we are, 1040. Infi is 1,200, right? By the way, all this is public data. I'm just making it fast here, but you can check this, right? What else did we have? We had Cipla. Cipla is 530 rupees, okay? Then we had Maruti, that is 3,800 rupees, all right? And then we had L&T, which is 1,250, right? So roughly we know the prices. Let me go back to our table, okay? ACC, 500 rupees you bought it. How much is it today? 1,200 rupees. That means it's gone up 2.5, 3 times. Reliance was 2,800, came to 1,200. It's now again 1,020. But here's the thing, and that's something we're going to do in the next session. It had given up bonus shares. Reliance had given bonus shares. So if you had bought one of this, you had another one which was given to you free. This happened 2-3 years back. So you should actually double the price of what is there right now. So 1,000 approximately is the price. It's 2,000, right? So it's gone up about, not that great, but about maybe 50% over a 6-year period. Infosys 1100, right? It's also 1001, but it did a 1:10 split. That means sorry, a 1:5 split. It gave you 5 shares for every one that you had. So you have 5,000 rupees for an investment of 1,100 rupees. Okay. Bharti, we didn't look at that. It's 700. It's around 350, 400 right now, but it gave you a 1:5 split. That means you have to multiply by 5. State Bank of India, it's saying 1,300 right now. And if you look at SBI, let's look at that because you're going to be a little shocked. Okay. So if you look at SBI, right, it is 200 rupees. Okay. SBI is 200 rupees, and you might be very rightfully wondering, how did India's largest bank, which was trading at 1,300, become 200 rupees? Right? That's because of what is called a corporate action. Again, it did a 1:10 split. So 200 rupees, which it is right now, translates into 2,000 rupees. Right? If it's not making sense, that's fine. Just hold on. The point, this discussion is not on corporate actions. That we'll come to in the subsequent sessions. ITC 170 is around 350. L&T was around 1,200. By the way, that gave a 1:1 bonus. And then Cipla, you saw, was around 300 or 400 rupees. So the question that I was asking is, if you had bought the stocks in 2003, 4 or 5, you had sold it in 2008, sat on cash for 1 year and then bought them in 2009, and you were holding them today, how much money might you have made? Very simply, a lot.
Four, about 4 to 5 times, yeah, probably.
4 to 5 times, you
Not
would have made a lot of money. Let's not get into the actual numbers, but do we agree that we would have made a lot of money?
Yes.
Okay. All right.
Yeah.
So different scenarios we discussed. If you had bought in 2000, by the way, so let's revisit this 2008 scenario where we said that if you had bought it in 2008, in 2009 you'd be sitting on a 50% loss. But had you not sold in 2009 and you were holding the stocks today, even though you bought them at these peak prices, would you be making money? Right? You would be. Now,
Yeah.
having said that, you're looking at 13 years of data. 2003 to 2016 is like 1.5 decades, and that's a really, really long period of time. And most retail people, let's admit this, and let's be very, so one of the things I like to focus on is being as practical as possible. So this is great in theory, but who the hell is going to wait for 16 years? Who is going to wait for 5 years and 8 years? We've all become like, I want my result now, I want my profit today, I want it this week or next month or next year, right? So we'll come to that when we talk about trading, but the point I'm trying to make with this discussion is what the market can do for us. Now, there are different scenarios. Scenario one, you could have bought in 2003, 4, 5, and you could be holding today. Even after the 2009 crash, you'd be making a good amount of money. Do we agree? Right?
Yes.
Second scenario, you could have bought in 2008 and sold in 2009, made 50% loss, and said for the rest of your life that the stock market is the worst place, it's gambling, my father told me not to do this, my mother told me not to do this, I made a mistake, and I should have listened to them and run away from the market from the rest of your life, which is what exactly, by the way, a lot of retail people did in 2008, right? Second scenario. Third scenario, even if you bought in 2008 peak, for some reason, maybe by fluke, maybe by luck, maybe by understanding, maybe by ignorance, maybe by forgetting, you were still holding the stocks today, you would have made a lot of money. The fourth scenario is what? You bought in 2003, 4 or 5, you sold in 2008, you bought them again in 2009, and then you were holding them today. That's the scenario which is going to make us the most amount of money. Do we agree on that? All right? And this is the promise that I'm making at this point, right? And I intend to completely deliver this. You want to write this down, I would request you to write it down, take a red pen, mark it. By the end of this course, this is what we would have learned, that 2008 was the best time to sell. Okay? That 2008 was the best time to sell, not to buy. It was the best time to sell. 2009 was a fantastic time to buy. And then you just repeat this process every few years or every few months. And what sort of money could you end up making therefore in the long term, right? So what I intend to deliver is our ability to realize or recognize that 2008 was a good year to sell, not to buy. And what I'm saying may not, may not really hit home right now, because in 2008, if you look back at what the media was saying, the bull market has just started. This is the best time to buy. Everybody was buying. But what you and I are doing in 2008 is exactly the opposite. You're being what is called a contrarian. And we are doing this, by the way, on the basis of publicly available data and information. Okay, this is what I want you to understand, that we are going to do all this on the basis of publicly available data and information. See the number 1028 or 2084, 2848. It doesn't tell you it's expensive. It doesn't tell you it's cheap. It doesn't tell you you should sell me now or you should buy me now. It's just a number. But our ability to go beyond these numbers and make a good decision is what we want to develop by the end of this course, right? And to be able to effectively and consistently through the rest of our lives be able to do something that I've highlighted here in the third bullet, right? Recognize when to buy, when to sell on the basis of factual data, not just on the basis of some casual opinion. That is what is deliverable in this course, right? Are there any questions? Is there anything that is crossing your mind? Feel free to put it out so that we can address that and factor that in our discussions.
Yeah,
So,
doctor, I have a question.
Yes, Talib, go ahead.
So when you say that the time to realize, is this going to be stock based or market based?
So the data that I showed you was stock specific, correct? Right? We looked at individual
Yeah.
stocks, but you could use a very similar approach to that overall market itself. Okay, so knowing that the market itself, not individual stocks or individual sectors, but the market itself is expensive or cheap, right? And as a matter of fact, when we come to fundamental analysis and we get into the practicals there, I'm not really going to be using company data, I'm going to be using market data. And the reason we're going to use market data is if the overall market itself is, too high or too low, then there's an 80-90% chance that individual stocks are also too high or too low. So first, let's figure out how to address the big picture. Then you can use the same process to address the micro picture, the small picture. That's number one. The number two point that it's good to look at the markets is simply because it's much easier, at least in India, to get market-wide data. It's a little challenging to get company-specific data. I'm not saying company-specific data is not there, but there are some issues with that, and we'll address that when we do the FA thing. Even going to global markets, whether you're in Europe, US, Japan, Africa, wherever, generally you will see that getting macro data is much easier for any exchange or any financial services, but getting micro data will always be a challenge, right? So what we're going to do, especially since we are right at the first stepping stone of the markets in our lives, we want to be able to really get good at doing that macro analysis and then refine that skill to do micro analysis if you want to do that, right? And just to reiterate, I mean, the entire course is intended to be like that, in terms of being practical, in terms of what is the data available to us. I don't think many of us are ready right now to go and spend, say, 50,000 rupees or $2,000 a month to get some advanced data subscription, stuff, which we are then going to use. Let's deal with what we have, and then when we get there, we'll do maybe an advanced course on that. Great. Any other question, Talib?
sir, I have a question. So,
Yeah.
what's the difference between the market data and stock data? Maybe I don't know the basics.
Okay, so no, good question. Just keep them coming in. Please don't hesitate to ask any question.
Yeah.
Right. So here, what we looked at was individual stocks in this table,
Okay.
right? And that's when I say stock data. Okay, what is a
Okay.
stock actually? Even that question we will ask in a little while. So here we're looking at individual companies or individual stocks. Now let me put a different slide up for you, and this is the chart of the Nifty itself.
Okay.
Okay, so if you look at it, you'll see 1997 onwards we have data, right? And you have another table, another chart here, but this is not of a stock. This is of the index. This is of the Nifty
Okay.
in India, right?
Okay.
So like that, there are indices across the world, and that's again one small topic that we're going to cover in a little while. So you have heard of Nifty, you've heard of Sensex, you've heard of Nasdaq, you've heard of Dow Jones, you've heard of Nikkei, you've heard of Shanghai, you've heard of the Australian index, the Bovespa in Brazil. All these basically, to answer your question right now and keep it simple, is to give you a sense of what is the overall market doing. Individual stocks may be up or down, we are not interested, but where is the overall market? And when I say market data, I'm referring to that.
Okay. It's a collective data.
Correct. You can put it as an aggregate and take everything that you want to observe together. So let me put it this way. It's like saying, what is the average pass rate of the class,
Okay.
right? If the average percentage pass is going up from 50 to 60 to 70 to 80, then you know everybody is doing better and better and better. But once it comes to say 90%, then there's not much headroom left, and most likely things will go down rather than go up. So then we're talking
Going
about
up.
market activity and market data, right? So does that answer your question?
Yeah. Yeah.
All right, great. What else? Feel free. Anything is fine.
Yeah.
Okay.
Um,
Yes, Talib.
there's some unrelated questions. I don't know if it's a good time for that.
Go ahead.
In your introduction, there was nothing about bonds.
Right.
Are we
Okay.
going to cover that, or?
No. So this course is only on equities. Okay, only on stocks, covering, so when you say talk about bonds, then you have to get into interest rate, understanding how interest rates and inflation changes. That's a completely different
Okay.
world altogether. Then you have commodities, all right? In commodities, you have things like gold and silver, precious metals, then you have industrial metals, then you have agriculture and all of that. That's a different universe all put together. Then you have real estate, right? Investing in real estate, and when I say real estate, not like buying a plot of land or some building or an apartment, getting a financial stake into a real estate project through the stock market, right? So that is a different thing. So that's a different asset class all put together. And then finally, though most people will probably disagree with this, you also have cash itself as an asset class. So just to clarify, so in this course we are going to be focusing only on the equity asset class, right? There are definitely things you can do in the bond market, um, that you can do in the commodity market, that you can do in the cash market, that you can do in the real estate market, which are very unique to each of those markets. And ultimately you'll tend to specialize in a particular market. And generally from a retail investor's perspective, equity market is what I think should be the first one to be learnt. And then once you built your competence on that, then you should look at the other ones. One other asset class, or not, I wouldn't say asset class, but an investment opportunity that I forgot to mention is the forex market, trading currencies, converting it from one currency to the other, and that's just another world altogether. So in this course, again referring back to the title, investing in equity, we're looking only at stock markets and equity markets. Right? Done. Any other questions? All right, so then let's move on. Okay, so the reason I do this exercise in the beginning, and again I would maybe request you to take this down as an exercise, is I want you to repeat this with your own set of stocks. Go and randomly pick out 5-10 stocks. Here are some rules, rather conditions. Don't pick all the stocks from the same group. They should not all be cement or all auto or all pharma or all, of one. Take one or two from each, whatever you are familiar with, all right? And at least from a minimum of 5 or 6 to a maximum of 10 or 12 different industry categories, right? And it doesn't matter, I really don't care which country you're in, which market you're looking at, or you might be in X part of the world, but maybe looking at some other part of the market to world to invest in, that's fine. But I want you to do this exercise and more or less convince yourself about what the opportunity in the market is, right? So this is just a template for you to, play with, and then you want to do basically an exercise like this. Look at what are the different scenarios that one would have gotten by investing, getting in and getting out at different times. Okay. So since Talib is in Tanzania, then just because of familiarity, you should look at Tanzania first. But then you know what? Today's internet world, you could look at anything. It really, really doesn't matter. Right? Okay. Any other questions? Okay, great. So this brings me to, one particular logical endpoint, which is wanting to convey the opportunity in the market, number one. Okay. Secondly, of if we learned about when to buy and when to sell, like buy when, what does low mean? What does high mean? What does cheap mean? What does expensive mean? If you don't have a benchmark, then you cannot, answer those questions. And that's the ability that we want to build. And if we did that, then what is the sort of wealth that we could create? Which brings me to the next set of discussions, which is how much wealth you can create in your, say, participating in the market over the next 10, 15, 20, 30 years, in short, over our lifetime, right? So in case, by the way, you happen to be watching this as a recording, this would be a good place where you may want to take a pause and take a break, and then you can, continue playing from here. All right. So very simple table, right? Really not much in it. If you have 1 lakh, and since I think these are some of the things that I need to, sort of change now. Not all audiences across the world will know what 1 lakh is. So let me do that right away. Right. All right. So that's much better. So you have 1 lakh of whatever, right? Rupees, dollars, dinars, really doesn't matter.
Doc, we can't see the slides.
Yeah. All right. There. I was just changing the 1 lakh to 100,000. Right.
Okay.
Okay. So I'm assuming you have 1 lakh of whatever is your, favored currency. Okay. I'm just using this as an example. What if you had, oh, 1 second, I didn't change it and all, just give me 10 seconds. I will change it everywhere. Okay.
Yes, sir, we can see.
All right. Thank you. Okay. So if you've got, 100,000 and you put your money in a fixed deposit in a bank in India right now, you'd get 8% interest, which means after 1 year, your money would have become, 108,000 or 1.08 lakhs. Now, if you just, just put that money back into the market, after 3 years, your 1 lakh would have become 1.3 lakhs. All right. So these numbers that you see here are basically what your initial 100,000 would have become at the end of 1, 3, 5, and 10 years. Okay. No great stuff on this. If you had instead of an 8% return, if you had gotten a 12% return, your same 100,000 would have become 112,000 after 1 year. It would have become 310,000 after 10 years. And similarly, if you got a 15%, your 100,000 would have become 410,000 after 10 years. So you just that money being reinvested, right? Simple. Any questions on this? Okay. All right. So time for some exercise. Here is another table. And you already saw that the Indian equity markets gave you 30, 40, 50, 60%. We are all agreed on that year on year, all right? But I've got just put 20, 25 and 30%, that's all. And here's the exercise that I want you to do. If you have 100,000 rupees, dollars, shillings, dinars, whatever, right now. And that's it. By the way, one thing to clarify, just 100,000. I'm not talking about a regular investment of 100,000 again and again. It's not like a, SIP or a repeated investment, just a one-time investment of 100,000. I know it's theoretical, but let's just work with this. And if that 100,000 was to grow at 20% every year for 10 years, how much would it become? If your 100,000 grew at 20% every year for 20 years, how much would it become? For 30 years, how much would it become? Right? So just like this previous table that we had, your 100,000 originally has become, depending on what scenario you're looking at, has become 108 or 410,000. What I want you to do, and again, don't take a calculator, don't take any, too much time to do this. Okay, I'm just going to give you a minute. And again, for those of you who are on the recording, you might just want to pause this and take a pen and paper. I want you to fill in these empty table, and you need 9 numbers. 1, 2, 3, 4, 5, 6, 7, 8, 9. Are you clear about what the exercise is? 100,000 is your initial investment and that's it. Nothing more. You're not putting a single rupee or dollar more. You just make sure it grows at 20% every year for 10 years, grows at 20% every year for 30 years, or it grows at 25 or 30%. How much would that 100,000 have become?
I did one row, the first row.
Okay.
Hello.
Yeah, go ahead.
So then at 20%, after 10 years, it becomes 6 times, 6.19 times. After 20 years, it's about 38 times.
Hey, hold on. Wait. You use a calculator, Excel sheet.
Yeah.
Sorry, disqualified. Right? All that.
No, before you said it, so I started
Then okay,
thinking.
fine. Then leave it. So that is disqualified, right? So yeah, I want you to do this without any help, right? Use only your mind, pen, paper, pencil. No calculators, no mobiles, no Excel sheets, nothing, right?
I just did a rough calculation. I posted it on the chat. 615.25 is what I put for the first row.
Okay, so you got 600,000 here, 1.5 million here, right? And 25.
1.5.
Okay, fine. And this is just in your head.
Just guess, yeah.
Okay, fine, done. All right. So if it went from 20 to 30%, so how much would it be? Instead of getting 20% annualized, you're getting 30% annualized, and how much would it be?
It would be around
I would
10
say,
times. 10 times?
Yeah,
So
10, 25, and maybe 50.
So this would be 10 times, this would be 25,
25.
And 50?
No.
Yeah.
All right. Okay. So this is an exercise you really want to do, okay? And the fun thing is to do this with your friends and family after this, right? But first is for you to get what you're looking at, and I'm being very dead serious about this, right? So let's look at the numbers, okay? Now here's something that I want to say. I always have fun doing this exercise. I've done it with hundreds of groups by now. I've done it with people from IITs, I've done it with people from MBAs and all of that. And I'll tell you one thing. I have not ever met anybody who has got the answers correctly, okay, when they have to do this on their own. If they're using calculators, Excel sheets, that's all fine. That obviously you'll get the answer, but that's not the point of this thing. The point of this thing is to understand the impact that this can have on your life in the long term, okay? So before I give you the numbers and the answers, here are some of the things to think about. When I say 10, 20, 30 years, I'm basically talking about you being in the markets over your working life, right? So most people who are looking at the market will start doing that maybe at the earliest in their mid-20s, but could be as late as in their mid-40s or 50s and all. Even if you're a 50-year-old, another 30 years of life, as in you'll, I don't know, maybe pop it at 80 or 90 is quite reasonable to expect, right? And especially if you're a 20-year-old or if you're younger, then wow, you've got another 30, 40, 50 years of life to look forward to. And I want us to understand what the impact of this is, right? So that's why the long-term perspective, and as you already saw, 20, 25, 30% is, at least as from the Indian standpoint, a very reasonable annual return to expect if you know when to get in and when to get out, right? Okay, what are the answers? Here are the actual answers, all right? Just, right, these are the actual answers, and I really want you to get your head around this. 100,000 rupees, okay? Almost everybody gets this part right, okay? After 10 years, growing at 20% every year becomes 600,000, 1 lakh becomes 6 lakhs, okay? If you got 30%, it will become 14 lakhs or 1.4 million, okay? Now, after 30 years, if you were growing your money at 20%, your 100,000 would become 23 million. 23 million, or in the Indian context 2.37 crores. All right, and if you can make your money grow by 30%, it will become 26 crores or 262 million rupees. Okay, and I really want us to spend a moment, and again, if you're watching this recording, I want you to take some time to think about what this means in your life. If you started early, if you started young, right, and if you are what, 25 years old, and by the time it's 30 more years, you'll be 55 years old, you will still probably be very healthy, you will have energy, and you could have anything from 2.5 to 26 million rupees, or 2.5 crores to 26 crores. And some of the people are thinking, oh, what about inflation? But I'm saying even after inflation, that is going to be a lot of money to have in your life. And please remember one thing, your only investment was 100,000 or 1 lakh. And the goal therefore becomes, and I want you to get this, is to just make sure, don't worry about 10 years, don't worry about 20 years, don't worry about 30 years, don't even worry about 5 years. There's only one goal that you need to do. Make sure that this year you get 20%. That's it. You know, make sure this year you get 20%, and God willing, inshallah, next year you're still alive, which most probably you will be, we'll deal with that next year. Make sure next year again you get 20%. And then God willing, you're alive in 2018, make sure you get another 20% in 2018. That's all. Forget about 30 years, forget about 20 years, forget about 10 years, forget about 5 years. Just take care of this year. Make sure your money grows by 20% and you are on track to achieve these results automatically. It's not more complicated than that, I promise you. A lot of us get overwhelmed by saying, oh my God, I have to do so much. I need to think about the I have no clue what the world will be tomorrow, day after tomorrow, next week, next month. We don't know what the crude oil price will be. We don't know if there's going to be another big fat war in Syria. We don't know if ISIS will take over, Saudi Arabia, for all you know, right? We have no clue. We don't know if Donald Trump is going to win, for God's sake. You know, we don't know. We don't know whether the monsoons are going to be good or they're going to be bad. Don't worry about it. Just take care of this year and make sure that you get your 20, 25, 30%. As we already discussed, the Indian markets have actually given much, much better than this. And what I'm trying to impress on for all of us who are on this or watching this is, what is the impact of this on your life? What is the impact of this on your family? What is the impact of this on your children? What is the impact of this on your retirement? What is the impact of this on all the things that you want to do? Buy a car, buy a house, all those things. Now I know some of us are thinking, what does it mean I have to wait till I'm 55 to have a good life? No, I'm not talking about that, right? I'm just talking about your initial 1 lakh. I'm sure there's a lot of 100,000 units that you have. And if you don't have them right now, you're going to earn them in the next 1, 2, 3, 5 years, right? And the reason I'm saying this is, for me, it's more than just numbers, markets, and money. For me, I relate to this very strongly because it is a direct impact on how my life can be lived. Because the bottom line is this: what is the first thing you think about when you want to do something? For yourself or for somebody you love, what's the first thing? You want to go out, you want to go to a restaurant, you want to have a holiday, you want to buy something. What's the first thing you instinctively think about? Tell me.
Money.
Money, correct?
Can I afford it?
Can I afford it? Exactly. That's the first thought that crosses your mind. And by the way, you don't have to look at your wallet or your bank statement. You know the answer as soon as you ask the question. You have this feeling that, yes, I can afford. Your sense of money is quite strong. You don't realize how strong it is, right? You may not know your bank balance. You may not know your exact salary. Okay. You may not know exactly how much this is, but you know what? I can't afford that car, but I can afford this car. I can't afford to stay in a 5-star hotel, but I can afford to stay in a 2-star hotel. I may not be able to afford a flight ticket, but I can afford a train ticket. You know that, right? And maybe for some of us this is a distraction, but please bear with me if it is. For me, doing stuff like this means taking my life and my family's life and my friend's life or whatever to an entirely different level. And that's what the markets are for me, not just a place to make money, but to make a difference to life itself, not only mine, but to others. That's why for me, this is like, sorry for maybe putting it so strongly, it's almost spiritual, because it has the ability to completely transform what I can or I can't do. Because the bottom line is this: almost anything and everything short of love and relationships and trust and integrity and all those things, which are of course the basis of things, everything else needs money. And if I don't have it, I can't do it. It's as simple as that. So if I can solve that, then a lot of things become possible. Any questions on this? Anything at all? Because I want you to be clear about this. I don't want any doubts, any ifs or any buts. So yes, go ahead.
Yeah, nothing specific to that, but do you mind restarting your camera? Your picture is all garbled.
Is it?
Might be a glitch or something. Yeah.
1 sec, I'll do that. Any questions on this? Any doubts?
Yeah, I don't know. There's one question, Dr. Musa. I mean, here, at least in this part of the world, relative value is something that is very important. I mean, we talked a bit about 10 to 15% dividend returns.
Yeah.
But then the local currency here devaluates by about 5 to 10% against the dollar, which is a benchmark that is used quite a lot here.
Sure.
So I mean, it's good to see these numbers, but then if you have inflation, you mentioned one, but also a devaluating currency on the other hand, which can be quite extreme in some cases.
Yes.
Then, I mean, what is it's good to see these numbers, but what is the relative value that you have of the money that has grown? I think that would be a bit more realistic, right?
Sure. So it's a very, I think, valid question. Comes up often enough. So there's some things let's get out of the way. Number one is that no matter what you do, and no matter what you do, you cannot change the inflation rate. Do we agree? Whether I have my money sitting as cash, or it's in the bank, or it's in the stock market, or it's in real estate, or whatever, inflation is going to devalue the value of my money. Are we agreed on that? Right?
Yes, unless you are in Europe or America.
Well, see, even in Europe or America, it's only a recent thing, as in the last 3-4 years, where you've got 0% inflation, right? And Europe and America and Japan right now have a worse problem. They have deflation, where things are actually falling in price, and that creates, just so that we are clear about this, a very different set of problems. Because if when you say deflation, what does it mean? It means things are becoming cheaper, right? Deflation means things are becoming cheaper, and now there's a big problem with that. While that looks very attractive, the point is this: it is better not to spend. If things are going to be cheaper tomorrow, next week, next month, next year, then I will not spend my money now. I'll wait for it to become cheaper. And the problem with that is, if almost everybody decides not to spend, and we're not talking about spending on food and stuff like that, we're talking about spending on houses, on cars, on new phones, on watches, on all those things that we need to keep manufacturing and consumption going. When consumption itself comes down because deflation happens, then where does the economy grow? And then how do you create jobs? What happens to young people? So inflation has been a key part of the global economy for the last hundreds of years. We have only data for the last 100 or 200, but deflation is a very new animal, and really the central bankers and the governments really don't know what to do about it. They're struggling, as we've already seen, right? But so it's a very relevant question, and if I was addressing a European or a Japanese or an American audience, I would have a lot more to say. But sticking to Asia and Africa and Southern America, etc., for example, we are not going to see deflation for a very long time. Not for many decades, at least, is what I think, right? So inflation is a reality, and a healthy reality, that we want to deal with. We don't want too much inflation, but we want some inflation, right? So coming back to your question of real value for money, yes, inflation is going to take away that value for money no matter what I'm invested in. So my goal becomes to make sure that my money is growing at a rate which is faster than the inflation rate. So as long as my money is growing at faster than the inflation rate, then I am okay, or I'm better off. That's one point on principle that I want to establish. Second, these returns that we're talking about, 20, 25, 30%, how do you want to, are these returns after or before inflation? Right?
Before
Because
inflation.
when you talk about real value or real return, if you say this is before inflation, then minus the inflation from this. Or if you say this is the real growth I want to achieve, then add the inflation number to this. If your inflation rate is 10%, then make sure you make 30%, 35%, and 40%. Right? So it can work both ways. Right? And this is a question that's been asked before, so that's why this clarity is there. These returns that you're seeing, 20, 25, 30, is pre or post inflation, is a decision you've got to make. It's about your money. So if you want to really create much more wealth, or real wealth as we are calling it, then make sure this is 20 plus inflation, 30 plus inflation. Right? So I hope that answers the question. But again, coming back to the point on principle, is that I can't run away from inflation. Inflation is going to affect me like time. I'm becoming older every day, whether I like it or not. And inflation is going to take away the value of my money, no matter what form my money is in, every day, every year, whether I like it or not. So my challenge is, whether I'm in the equity markets, whether I'm running a business, whether I'm in this bank, to grow at least at the rate of inflation, and most probably better to grow at a faster rate. Right? Coming to the second point that you asked, and the question you asked about currency devaluation. Okay, there are 2 points on currency devaluation. One is, do you want to, where is your main spending that's going on, right? So if your main spending is in, let's say in your case, Talib, is in Tanzania, right? And you're earning in Tanzania and you're spending in Tanzania, then usually that is not such a big deal, at least when you have stable inflation, right? Steady low rates of inflation and currency are steady. But if currency devalues, like say in Zimbabwe, then you've got a crisis on your hand. And what's eventually going to happen is you're going to ignore the local currency and you're going to trade only in the foreign currency. As you already know, in Zimbabwe, the local currency doesn't work. It's all dollarized now, right? But coming back, even in the Indian rupee, about 2 years back was around 50, 55 rupees. Now we're looking at 60, 65 rupees. But something which is steady and allows prices to adjust in the economy is okay. But if it's sudden, then we definitely have a problem. Having said that, again coming back to where is your personal expenses. Now suppose you are earning in Tanzania, but you're sending your money to India. Then devaluation is a problem. Definitely devaluation is a problem. And we've seen that happen in the last 6 months, 1 year, for the, the currencies in the Middle East when the crude oil has fallen, right? They buy less rupees for every dinar that they have. So if you're earning abroad but sending your money to your family in a different country, then all these foreign exchange fluctuations become definitely an issue. I don't want to at this point go into macroeconomics or corporate economics. Let's just keep it personal in terms of I'm earning, I'm spending. I'm earning in the Middle East, but my family is in India or in Sri Lanka or in Bangladesh or in Africa or wherever, or the other way around. I might be in Africa, but my family is maybe in London, right, or in the US. That's definitely the case in a lot of families in East Africa, where the families are in in London, but the earning member is in East Africa, and then devaluation becomes an issue, right? So I think the question then becomes, uh, you've got to look at your personal circumstances to really ask that question: is how am I going to deal with devaluation? Simple answer that I could give, which your company will not agree to, is get your salary in dollars. Tell your company, I don't want local currency, right? I want it in dollars. But see, the risk becomes what? What if appreciation happens? Then can you go back and tell your company, no, now give me local currency? They'll not agree, right? So this brings me to a very different point, which is the importance of financial knowledge today. It's becoming very, very important to have financial knowledge in order to use that knowledge not only in the stock markets as this discussion is going on, but even in things like this, in negotiating your currency of payment. Like for example, in BIC, Bangalore Investors Club, there are people who are working in India for MNCs, but they've negotiated their payments in foreign currency. Okay, now over the last 2 years, even if his dollar pay has not increased, his rupee pay has increased because the rupee has gone from 55 to 65. But the same person, if let us say the Indian economy grows very strongly, blah 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 blah, and the dollar pay does not increase, 65 could go back to 55, and we were at 38 also at once upon a time. So these risks have become real, and it becomes, I think, even more important that we understand these things, because these, even if it doesn't affect you in a 1 year, 2 year period, it will affect you in a 5 year, 10 year period. Okay, but I again go back to the first point that I made, which is inflation, devaluation are things you and I can't do anything about, right? And then the real answer, I think, is in knowledge and implementing that knowledge in order to overcome those challenges. Right? From what little I know about you, for example, Talib, is that I know you're a businessman, right? Or you are in a family business, etc. Now there are places in the world where the quotation is not in the local currency. This has happened in the 70s and 80s in Brazil. It's happening in Zimbabwe today. And who knows if the rupee crashes, or I think it's the shilling in Tanzania, correct?
Yeah.
Yeah. If that
Yeah.
suddenly were to, go very volatile, I promise you that people will start to say, look, if I give you a shilling quote or a rupee quote, it's valid only for 1 day, 1 week, 1 month. But if I give you a dollar quote, it's valid for the next year. So you adapt, right? But I think, again, coming back to the personal point, it is, yes, if you are in an environment which is in a devaluation zone, right? See, again, then are you an importer or an exporter? If you're using a lot of imported items and the currency is devaluing, you're in big trouble. But if you're exporting a lot, then you're very happy. So I have a lot of friends who are garment exporters, and they are like terribly happy when the rupee falls. because they get dollars, but now they earn more rupees, and you pay in rupees everything here, and your profit margin increases. So it cuts both ways. Really depends on which side of the equation you are. So went off a little bit, definitely went off tangent, but good discussion and relevant, I would say. Any other questions? Vetri? No? Okay.
No, sir. We can continue.
All right, great. All right, so just before leaving this slide, one thing I want to point out, because I've noticed that most people don't actually notice it. I'm going back to the previous slide, and what sort of y-axis do we have? Can you describe the y-axis here? How would you describe it? Just simple
What time?
mathematics.
It's linear.
I mean,
It's a
why?
yeah,
No,
it's a linear scale, 0, 1, 2, 3, 4, 5. Simple as that, right? That's a linear scale. Let me go back to the other slide. What sort of scale is this?
Exponential.
uh,
It's a logarithmic scale. It's an
Yeah.
exponential scale, right? Because when I created these slides, originally this was also a linear scale. And what happened is these bars were just thin lines here. You couldn't make them out at all. And then this one would shoot up. So since I think some of you would have done your magic on Excel, you should take the results, these numbers, these tables, 6 lakhs, 26 crores, etc., and create a graph out of it, and do it both in a log x-axis, y-axis, and a linear y-axis, and see. The point I'm trying to say is human beings are not very good with numbers, okay? But we are very good with graphics and visuals. When you convert this into a table, this is not hitting you because it looks like from here to here is not a big increase. That's because this is in a log scale. But make this a linear scale and you will see that it's just going to zoom up in a sort of exponential manner. And I'm saying all this only for one reason, which is to convey to you the sort of wealth that can be created over time. Okay, so let me put this in a different nutshell. I'm sure all of you have this much capital, okay, 100,000 of whatever, and if you don't, I'm sure it's on its way, right, through your savings and all. Second, we are now talking about the markets. The opportunity to invest and create this sort of returns is established. So what is coming in between you getting this result and the money that you have? The way I look at it, it is your action and my action. You've got to now play the game. As simple as that. Right? Okay. So what I'll do here is I'm going to stop this session here before we go on to the next thing. And I'm going to create a separate link for the next one so that this can be in proper logical steps. Right? So any questions before I close this?
so now we are closing and
Yeah, so I'll close this and I'll send you another link basically.
okay.
Okay, so
But this is not.
this is not?
But this is not a break, right? For
No, this is not a break. This is not a break.
1 hour
You
break.
can you, you can you
Okay.
can have some refreshments if you want, but not a break.
Okay.
Any questions? Anything we've covered so far?
No.
Okay, super.